Picture this, I was 22, fresh at my first job and eager to invest. I dumped all my savings into a hype tech stock without research or a plan. For a week I felt brilliant. Then the market crashed and I panicked, selling at a huge loss. That painful lesson? Everyone makes mistakes starting out. The key is learning, adapting, and not letting one setback derail your journey. Today, I'll show you the 5 biggest investing mistakes young professionals make, and how to avoid them. Let's talk about a common pitfall in the world of investing. Mistake number 1, investing without a clear goal. It's a surprisingly frequent error, and it can have significant consequences for your financial future. Investing aimlessly, without a specific objective in mind, is like driving with no destination programmed into your GPS. You're just wandering, hoping to stumble upon something good. And in the process, you waste valuable time and hard-earned money. You might end up taking unnecessary risks or missing out on opportunities that align with your true aspirations. So, how do you avoid this mistake? Set specific measurable goals, like saving $25,000 for a down payment on a house in 4 years, or accumulating $1.5 million for a comfortable retirement by the age of 60. Your goal shapes your entire investment strategy. It dictates the types of investments you choose, the level of risk you're willing to take, and the timeline you need to follow. Short-term goals, like saving for a down payment, need stability and lower-risk investments to protect your capital. Long-term goals, such as retirement, can handle more risk and benefit from growth-oriented investments that have the potential to generate higher returns over time. With a clear target in sight, every investment decision gets easier. No more guessing or wondering if a particular risky investment truly fits into your overall financial plan and helps you achieve your objectives. Your goal keeps you focused on the big picture and prevents impulsive moves driven by market hype or fear. Make your goal your North Star, guiding you towards financial success. Mistake number 2, a very common pitfall that many investors stumble into. It's a mistake rooted in the desire for control and the allure of quick gains, trying to time the market. This is the siren song that lures even seasoned investors onto the rocks, waiting for that elusive perfect moment to invest, that supposed sweet spot where everything aligns just right. But this strategy usually means missing out on significant gains. The market rarely waits for anyone. No one, and I mean no one, can consistently and accurately predict market highs and lows. The market is simply too complex and unpredictable. Not even the pros with all their fancy algorithms and years of experience. They're just as susceptible to market fluctuations as anyone else. My friend Alex, a bright and otherwise savvy individual, waited patiently for a major market crash, convinced he could buy low. Then, after the crash, he waited even longer, trying to pinpoint the absolute bottom before jumping in. And guess what? He completely missed the subsequent market recovery, a period of substantial growth. Studies consistently show that the best market days often immediately follow the worst performing days. So, if you're out of the market trying to time it, you inevitably miss both the downturn and the subsequent rebound. The solution to this dilemma? Dollar cost averaging, a simple yet powerful strategy. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. Whether the market is soaring or plummeting, you stick to your predetermined investment schedule. This approach effectively removes emotional decision-making and eliminates the need for guesswork. Ultimately, this allows your investments to grow steadily and consistently over the long term. Always remember this crucial principle. Time the market consistently beats trying to time the market every single time. Mistake 3. Ignoring fees and expenses. A 1% annual fee sounds small, but over decades it can cost you tens of thousands. For example, after 30 years, a $10,000 investment with a 1% fee could be worth $18,000 less than a low-fee fund. Always check the expense ratio before investing. Aim for funds with fees under 0.1%. High fees quietly eat away at your returns, so be a fee detective. A few minutes of research can save you a fortune. Don't let fees sabotage your future. Mistake 4. Lack of diversification. I learned this the hard way by betting everything on one stock. When it tanked, so did my savings. Diversification spreads your risk. Own stocks across industries, add bonds, maybe real estate or international funds. The easiest way? Buy a broad market index fund or ETF for instant diversification. It's not flashy, but it's safe and effective. Don't risk everything on one bet. Spread it out. Mistake number 5, a critical one that can derail even the most well-researched strategies, is letting emotions drive your decisions. It's a common pitfall, but understanding it is the first step to avoiding it. Fear and greed. These two primal emotions are powerful forces in the market. They can make people buy high, swept up in the excitement of rising prices and the fear of missing out. And conversely, they can make you sell low, driven by panic as the market declines, locking in losses. This often leads to panic selling in a crash, a knee-jerk reaction that can decimate your portfolio. Or chasing hype at the top, jumping on the bandwagon of trending stocks just as they're about to crash. In 2020, during the initial market shock, many sold at the bottom, succumbing to fear and uncertainty. And then, they missed the subsequent rebound, a potentially huge missed opportunity to recover losses and even profit. Conversely, others bought meme stocks at the peak, fueled by social media frenzy and the promise of quick riches. And as we all know, many of them lost big when the bubble burst, a painful lesson in the dangers of speculative investing. The fix? It's simple in theory, but requires discipline. Set a plan, a well-thought-out investment strategy aligned with your goals and risk tolerance. Automate your investments, setting up regular scheduled contributions to your chosen investments. And most importantly, stick to it, no matter what the headlines say, ignoring the short-term noise and focusing on the long-term picture. Dollar cost averaging, a strategy of investing a fixed amount of money at regular intervals regardless of the price. This helps you buy through ups and downs, smoothing out the average cost of your investments over time. Ultimately, this removes emotion from the process, preventing impulsive decisions driven by fear or greed. Remember, your biggest enemy is often yourself, your own emotional biases and tendencies. Tame your emotions, cultivate a calm and rational approach to investing. And by doing so, you'll significantly increase your chances of winning in the long run. There you have it, the 5 biggest investing mistakes and how to dodge them. What's the worst investing mistake you've seen? Share in the comments so we can all learn together. Remember, perfection isn't the goal, progress is. Learn, adapt, and keep moving forward. Every smart dollar invested today builds your future. Don't let fear stop you, start now. If this helped, like and subscribe for more tips. Thanks for watching. If you enjoyed this video, don't forget to like and subscribe to the channel for more content like this. Before you go, if you enjoyed this video, don't forget to hit that like button and subscribe to the channel for more content just like this. Join our growing community of smart investors. You won't want to miss what's coming next. Click subscribe, turn on notifications, and let's keep building your financial future together.